Today, September 15, marks the 15th anniversary of the collapse of Lehman Brothers, which led to over 3 months of chaos in global financial markets and practically seizure of all lending by banks everywhere. September 2023 is also the 10th anniversary of the Taper Tantrum, a slightly smaller problem perhaps, the Fed pulling out dollars that it had printed to solve the Lehman problem. The Taper Tantrum hit India harder than many other countries, taking the Indian rupee from 53.50 per dollar in end May to 68.80 per dollar in end August 2013. To understand what lessons we have learned from these two events and how they have changed both financial markets and regulatory approach to financial markets, I have with me two experts who saw this crisis literally inside out. Mridul Saggar, the former ED and member of the RBI MPC, who was in RBI at that time, now professor at IIM Kozhikode, and Sajjid Chinoy, chief economist, JPMorgan India, who I guess tabulated everything that happened from the outside. Gentlemen, thank you very much indeed for joining me. Mridul, let's first take the big lesson. Work backwards, as it were. Is it fair to say that ugly as the Lehman crisis was, the lesson learned 15 years from now is banks everywhere are a lot better capitalized, lot better safer?
The 15 years of global financial regulatory reforms have definitely strengthened the resilience of the financial system. But it's still a bit of unfinished agenda. I don't think we need to slacken on that. Clearly, the capital buffers, the liquidity buffers, the LCRs, the NFSRs, in terms of the TLAC in particular, ending the too big to fail, they are very important measures which have been taken. But I am a wee bit worried that the political consensus on these reforms is still lacking, and it is contingent on what might happen in the US in the next presidential elections. If we have survived the banking crisis, which was emerging earlier this year, it's essentially on the back of the global financial regulatory reforms.
Mridul, would you agree to that? That the manner in which it was solved by liquidity is a price that we are still paying?
Absolutely. Again, Latha, I think the unconventional monetary policies have gone too far, and we need to sort of see its unwinding. So these are not very standard tools as the West countries have begun to think. And these should be used sparingly in times of crisis and should be rolled back. In all fairness, Fed is the only central bank which rolled back the unconventional monetary policy after 2008 crisis. The ECB, the Bank of Japan have not been able to do that. So I have some sympathy for Fed on that. But again, I think it's a word where too much dependence is there on forward guidance, as if markets have, it's not the job of the markets to take positions on what might happen. So everything, all risks, the markets don't want to take now. And that's something we need to correct.
Mollycoddling of markets by regulators is what you're pointing out, being too beholden to markets. Sajjid, while the positive of the Lehman crisis appears to be that banks everywhere are better capitalized, would you say the manner in which it was solved by gushing out liquidity has created problems even up until today?
Latha, I agree. I think the implications of Lehman are far more profound and far more long-lasting and are impacting us even today. Let me give you 3 implications. I think one is that the recovery post-Lehman was very anemic, right? It took 8 years for the global economy to close its output gap and go back closer to trend level. And that economic malaise or stagnation actually, in my mind, helped sow the seeds for deglobalization, secular stagnation was blamed on globalization in some quarters. And this was the decade of Brexit and the US-China trade war. And I think those deglobalization tendencies got firmed up in that decade of malaise. The second lesson in my mind was the misuse of fiscal and monetary policy that you alluded to. Fiscal policy was inexplicably too tight. structural fiscal deficits in advanced economies tightened between 5 to 10 percentage points of GDP in a decade. And that choked off the economic recovery and contributed to the economic malaise. Now, the implication of that was by the time policymakers realized in 2018-19 that fiscal had tightened too prematurely, the pendulum swung the other way. And the next time a crisis hit, which was the pandemic, fiscal policy overcorrected in the pandemic, and we're still paying the price of that from some advanced economies. The third implication, as you said, was, because fiscal was tightening and there was this economic malaise, monetary had to do all the heavy lifting. And once the zero lower bound was hit, this whole Pandora's box of unconventional monetary policy opened up. I would argue it had a really crucial role to play in 2008-9 to avoid the recession from getting worse or facing a depression. But what happened was, once this became mainstream, as Mridul alluded to, then monetary policy soon became the only game in town and began to substitute for more important structural reforms. So I think all of these three factors, the wrong choice of fiscal and monetary is still impacting us. It dictated the way policy acted in the pandemic. And I think part of the high inflation we're seeing around the world is because fiscal policy moved too aggressively, having learned the lesson that it was too tight after Lehman.
Okay, so I don't know if when history is written for this period, the fiscal policy will be blamed, just as we now blame monetary policy for the 2008. Coming to you, Mridul, go ahead.
A slightly different take from Sajjid on this one. And while I completely agree with Sajjid on monetary policy becoming the only game in town, I have to say that the counter-cyclical fiscal policies are the need of the hour. And that's not something we are doing, but that's something which actually helped the West actually give a larger fiscal stimulus at the time pandemic shock came. So you look at how Eurozone really rolled back the fiscal side, because if they hadn't rolled back the fiscal side, the fiscal gaps would have remained too large to give the fiscal impetus.
Okay.
So that's the limited
Fair
point.
Fair enough. I mean, we'll analyze it more, but let me come to the taper tantrum. As Sajjid points out in his paper, in his latest paper, the taper tantrum completely exposed India in terms of a country at that time with a high current account deficit and its inability to immediately react to the coming crisis of taper. But now, although the tightening of the Fed was much higher, from May 2013 to August 2013, the Fed hadn't tightened so much. It had only said it will tighten. But this last 12 months, the Fed tightened all the way from zero-bound interest rates to 5.5%. But the rupee was as sturdy as ever. So do you think we learned the right lessons from the taper tantrum, Mridul?
Okay, see, the two events were very different. The taper tantrum and the current tightening was very, very different. So in taper tantrum, fragilities were very large. India was part of the fragile five. Clearly, the fiscal deficit was ballooning to 6% of the GDP. Growth was falling sharply from above 8 to more like 5% in that year. Inflation had shot up to 11%, plus current account deficit had ballooned also to 4+. So the moral of the story is that one has to stay focused on macroeconomic stability, because without that, nothing can get done. The lessons of the taper tantrum were learned, and in the sense, the Fed has been more restrained in communicating the tapers, which it does, prepares the market now. In taper tantrum, I distinctly remember that Esther George was dissenting in each FOMC, and Powell was also taking the same line,
Mridul,
but not dissenting.
Mridul, I will come to you to get a nuance by nuance, blow by blow account of both these important events. But for the moment, the key lessons that we've learned from Lehman and taper tantrum are, according to you all, as follows. One, banks are now much better capitalized, and regulators are careful to ensure that they do not go overboard on lending. And from a taper tantrum, India learned the major lesson that macros like fiscal deficit and current account deficit, as well as inflation, need to be kept under check. Valuable lessons. Let's take a break and come back after the break and look at more nuances from these two important crises. Welcome back. It is the 15th anniversary of Lehman crisis to the day, and it is the 10th anniversary, so to speak, of the taper tantrum, which happened in global financial markets, especially EMs, from May 2013 to August 2013. So looking back at both these events, our two experts, Mridul Saggar, former executive director at RBI and now professor at Kozhikode, Sajjid Chinoy, chief economist at JPMorgan. Sajjid, Mridul, thank you very much for waiting. Mridul, now to get to the Lehman crisis, and as you saw it from the Reserve Bank, can you give us the blow-by-blow account and what went through your minds at that time in RBI? Was there a fear of imminent collapse?
On the Lehman?
Yes.
Yes. On the Lehman, everyone was clear that this crisis is becoming bigger and bigger, and spillovers will be there. I think it's a mistake to blame everything on Lehman being not bailed out during the crisis. I think Lehman didn't have enough collateral, and with the classic Walter Begert rule, it was difficult to bail out Lehman. But Lehman alone did not cause this crisis because essentially, if you see the spreads between the long-term banking rates and the overnight rates, they sort of spiked not on September 15th, but on September 19th, when the US Treasury announced that it will be putting in US $700 billion for bank bailouts. That's what it will go to Congress for the bailout. So I think people overrate Lehman as the point.
Okay.
So important point here is the lesson is that the bailout strategies and the bail-ins which came later are important. We should have a clear framework for that.
Okay. Sajjid, to come to you, do you think India overreacted to the Lehman crisis, which was perhaps more a North Atlantic crisis, as Rakesh Mohan calls it, more of America and Europe? And we need not have gone too loose, both with fiscal and monetary policy at that time.
Well, Latha, like the pandemic, there was so much uncertainty that I don't blame policymakers at the time for saying we need some more insurance here on the growth front, because we just didn't know how acute the linkages would be, both on the financial side and the trade side. Were we entering some kind of global recession? There was too much uncertainty. Now, hindsight is 2020, but with hindsight, perhaps what needed to be done is, even if the initial stimulus was large, both for fiscal and monetary, that once it became clear 3 quarters later that India had been relatively unscathed, that growth was rebounding, the financial system was very sound, that at that point, perhaps the stimulus that had been injected could have been withdrawn sooner. Because what happened was the private sector rebounded rapidly in 2011, right? 2009, 10, and 11. But because there was all the stimulus still in the system, and it was being withdrawn very, very slowly, it set up some of these vulnerabilities that you alluded to earlier: the higher fiscal, the higher current account deficit, the real exchange rate appreciated, and that set us up for some of the trouble around the taper tantrum. So, with hindsight, it was not so much that the stimulus was too large, it was withdrawn too slowly in the subsequent years, when it became clear that the impact from Lehman was quite minimal.
Mridul, you agree?
Agree on this, absolutely, with Sajjid on this. And the lesson here is that we need to be vigilant all the times. For instance, in the very present context, if your credit growth is hitting 20%, it's time you sort of react to it. The counter-cyclical buffers which the bank are supposed to build in good times are still not in place. So this is an opportune moment. And one would watch for the October policy if it does that.
Okay. That's important. Mridul, actually, then to come to the present day, Sajid writes in his column that there is a danger that the fiscal support given in US and Europe during COVID may overstay, because in Lehman, monetary policy did all the heavy lifting. Now is fiscal threatening to go overboard? After all, the US rates at 4.3, the 10-year yields, are telling us that they are worrying about a large deficit in the next 2-3 years, the Fitch report. Mridul.
Sorry, yeah. So I'm not too concerned on that at the moment, but I have already voiced this earlier in a newspaper article that actually we need to have a more stronger fiscal consolidation at this juncture. On the monetary side, the problem is that the global growth slowdown is really coming through. And so that is sort of putting some hassle. But again, the dithering on this thing could be costly because inflation is coming back. And one has to be watchful, not just in India. I mean, you look at any emerging market or the West, last 2 months inflation data is a tick upward and commodity prices have started increasing. So we have to be cautious of these sort of things.
Okay. So, Sajid, what's your takeaway? Do you think that we are in danger of the fisc doing too much in this particular instance? I mean, more particularly in the US. And it's a strange thing. India will have to react if US 10-year rates are at 4.3. Even if we controlled our inflation better, as the latest number indicates, we really don't have elbow room. We have to keep our rates high.
You know, what's been mind-boggling is this lack of coherence between fiscal and monetary policy in advanced economies for the last 15 years. It was the 15th anniversary of that incoherence, right? I spoke about the fact that, fiscal and monetary were nullifying each other after Lehman. I completely agree with Mridul that you have to build counter-cyclical buffers, that fiscal has to correct in the good times. My only concern was that it overcorrected between 2010 and 2017, where the structural deficits were tightened by 5 to 10 percentage points of GDP. Now the opposite has happened. Look at what's happened in the US in the last 18 months. The Fed is scrambling to contain inflation. They've raised rates by 500 basis points in a year. And guess what fiscal policy did this year in the US? It expanded by 3 percentage points of GDP, right? So fiscal clearly was not helping the Fed's cause and clearly was not helping inflation's cause. So hopefully, a wiser counsel will prevail, and going forward in advanced economies, both fiscal and monetary will reinforce each other.
Okay, actually, out of time, but I want 10 seconds from both of you on only one question. More generally, Mridul, do you think that EMs have been more responsible both during Lehman and during the Taper Tantrum response?
Yes,
and COVID.
They are more responsible. Unequivocally, yes. But Latha, I also won't get scared on some things, especially the digital space.
Okay.
And that's where the G20, which has strived for an agreement, crypto regulation is on card, and IMF FSB synthesis paper has been taken, pushing aside the BIS view on one side. And that could be still a source of the next financial crisis, is my worry. So what would EM do doesn't really matter.
Last thoughts, Sajid, just 10 seconds.
Yeah, Latha, we've spoken on all the ills around the economy. Let's give ourselves some credit. We saw the most aggressive monetary tightening in the world in 40 years last year, and India was relatively unscathed. Because as we wrote in our piece this morning, we drew the right lessons from the Taper Tantrum. Buffers matter. Today, our reserves are almost twice gross financing requirements. Real exchange rates are positive. We have an inflation targeting framework. Inflation is half the level it was in 2011 and 12 for the 6 years before the pandemic. The real exchange rate is not misaligned. So we've learned the right lessons, which is why India was able to fortify itself over the last 12 months in that amidst the global turmoil.
Got that. Out of time, but yes, a pat on the back for EMs, especially for India. But very important, Mridul Saggar pointing out that the synthesis paper coming from the IMF on cryptocurrency regulation could perhaps overlook the red flags raised by the BIS? And are we in the throes of another crisis, this time perpetrated by fintechs and cryptos? Well, we will have to wait and see whether we have learned all our lessons. Thank you very much, Mridul Saggar and Sajjid Chinoy, for joining me and analysing two big events for financial markets, the global financial crisis of 2008 and the taper tantrum of 2013.